Good afternoon. This hearing of the Subcommittee on Intellectual Property, Competition, and the Internet will come to order. Today's hearing examines the Dodd-Frank Wall Street Reform and Consumer Protection Act, better known as Dodd-Frank, and its effects on competition in the financial services industry. The free flow of capital is the linchpin of our capitalist economy. We must be extremely cautious about any attempts by the federal government to thwart the ability of the private sector to choose, through the allocation of private sector resources, which ideas and businesses are meritorious and which should be left on the cutting room floor. Unfortunately, Dodd-Frank injects government bureaucrats into the decision-making process in the flow of capital. This raises unnecessary and artificial hurdles to our economic recovery and distorts competition in the financial services market. Even before the 2007-2008 crisis, there was tremendous concentration in some markets related to the housing bubble and the toxic securities that brought our economy to the brink of collapse. The subprime mortgages at the root of the crisis were repurchased and securitized by the government-sponsored duopoly of Fannie Mae and Freddie Mac. The mortgage-backed securities that Fannie and Freddie created were given AAA ratings by the big three ratings agencies, which controlled about 95% of the market. These securities were then purchased by the largest Wall Street banks, which have consolidated an ever larger share of the market over the past few decades. Perhaps more competition in all of these markets would have encouraged more responsible decision-making and helped to avert or limit the crisis. However, instead of fostering more market competition, Dodd-Frank is likely to entrench current market leaders, making it harder for small and innovative banks and financial companies to compete. Dodd-Frank does nothing to decrease the market power held by Fannie, Freddie, and it will likely have the unintended effect of encouraging consolidation in banking and other financial sectors. Dodd-Frank will harm competition in the financial services industry because its regulations fall hardest on small banks and credit unions, which makes it harder for them to compete with their larger counterparts. Regulations always fall harder on small businesses than large. In the banking sector, the costs of complying with regulations have historically been 2.5 times higher as a share of operating expenditures for small banks than for large. If the costs of complying with Dodd-Frank are too great, it could drive many local community banks out of business or force them to merge with larger competitors. If Dodd-Frank results in community banks and credit unions leaving the market, not only will competition suffer, but so will the communities and small businesses that these banks serve. Small and mid-sized banks account for 54% of small business lending. America's small businesses need these loans so they can create jobs. The government should be doing everything possible to encourage small businesses to grow and create jobs. At a time of sustained unemployment, and with the President proposing to raise taxes on America's small businesses, the last thing we should do is bury the community banks that finance small businesses beneath a new mountain of regulation. The Dodd-Frank Act could also harm competition by designating certain banks and non-bank financial institutions as systemically important and creating special liquidation procedures for them outside of bankruptcy. These special liquidation procedures treat systemically important companies' creditors better than the bankruptcy law. As a result, systemically important institutions, already among the biggest companies in America, may receive favorable treatment in the credit markets. This could lead to even more concentration. The administration is fond of touting the supposed reinvigoration of antitrust enforcement out of the Department of Justice and the Federal Trade Commission, but the Dodd-Frank Act, like the administration's other signature legislative achievement, the Affordable Care Act, will have the effect of hindering competition in one of the most important sectors of our economy. It's now my pleasure to recognize the ranking member of the subcommittee, the gentleman from North Carolina, Mr. Watt, for a different perspective.
Maybe not so. I thought I was in the Financial Services Committee here for a little bit, but I hope the chairman will forgive me if I say bluntly at the outset that I believe this hearing is much ado about nothing. The Dodd-Frank Wall Street Reform Bill, which I often affectionately call as a member of the House, the Frank-Dodd Reform Bill, was the culmination of years of efforts to rein in predatory lending and other major abuses in the financial services sector, and to reduce the prospect that financial institutions get too big to fail and taxpayers end up getting stuck with the cost of bailing them out. The bill establishes an entity for the first time in the federal government, the Consumer Financial Protection Bureau, that has as its primary purpose protecting consumers of financial products and erects a comprehensive regulatory regime designed to reduce the incentives that drove many financial institutions to pay much more attention to making excessive profits than to protecting the interest of their customers, our nation, or our economy. I co-sponsored the legislation, and as a member of the House Financial Services Committee, played a major role in crafting many of its provisions. And together with Ranking Member Conyers and our colleague, Ms. Waters, served as a conferee on the House-Senate conference that produced the final product. Although I served as a conferee representing the Financial Services Committee, I also brought to the conference my antitrust and other policy experiences from this committee. I believe the Dodd-Frank bill reflects the goals of both competition policy and stabilizing our financial institutions. Mr. Chairman, I think my views on how this committee addresses antitrust concerns are well known. While educating our citizens on pending antitrust matters serves a very important public good, I generally believe that we should allow the regulators to do their jobs, especially when they have access to a wealth of detail that is not in the public domain. When Congress intervenes to affect the outcome of an antitrust investigation, I believe it can place undue pressure on the regulating bodies. But here we are having a hearing on the Dodd-Frank Act effects on financial services competition, effects that have yet to be seen. There are no concrete set of concerns before us. We are simply relitigating issues that were carefully studied in crafting the Dodd-Frank legislation. As for the Act itself, Section 6 of the law contains a specific antitrust savings clause designed to ensure that antitrust policy continues to have a place within the regulatory framework. And I quote, "Nothing in this Act or any amendment made by this Act shall be construed to modify, impair, or supersede the operation of any of the antitrust laws unless otherwise specified," close quote. That's directly from the Dodd-Frank legislation. Now, in the past decade, the Supreme Court has issued two decisions that have called into question the role of antitrust policy in regulated industries. The Trinco and the Credit Suisse cases have been the subject of hearings before this committee and were not overlooked during the construction of the Dodd-Frank Act. In Trinco, the court upheld the effect of a general antitrust savings clause but found no violation of the antitrust laws. In Credit Suisse, the court refused to give effect to a broad, non-specific savings clause, finding instead that there was an implied antitrust immunity in essence to avoid conflict between incompatible regulatory regimes. There are those who question the reach of both Trinco and Credit Suisse. Are they limited to the regulated industries involved in the facts of each case, telecommunications and securities, respectively, or do they apply generally to all regulated industries? Whatever the answer to those hypothetical questions, the fact of the matter is that many of the regulations that will shape our financial sector moving forward have yet to be issued or implemented. Moreover, The Obama administration adopted the position when it inherited a financial industry on the brink of collapse that it would increase antitrust enforcement in regulated industries and maintain enforcement during the economic crisis and recovery. And the Justice Department has conducted 4 investigations into the financial services markets since the rulings in Trinco and Credit Suisse, 3 of which are ongoing into the municipal bonds, investment credit, credit derivatives markets, and the London interbank offer rates, or LIBOR as it's sometimes called. The Department of Justice has also been active in the rulemaking process mandated by Dodd-Frank. Now, I'm sure that there will be testimony today about how Dodd-Frank disadvantages small and community banks and advantages large financial institutions that some believe are, quote, too big to fail. On this issue, I will simply make 2 points. Number 1, small and community banks were disadvantaged vis-a-vis large financial institutions long before there was a Dodd-Frank bill. In my view, Dodd-Frank significantly leveled the playing field between larger and smaller banks, and it seems to me that a major part of the dissatisfaction with Dodd-Frank is that we could never absolutely level the playing field, just as we have not found it possible to, over the history of our country, to level the playing field between the rich and poor in this country. Yes, I keep complaining about that, and I don't begrudge those who keep complaining about the disparity between large and small financial institutions. Perhaps we can and should do more, but I don't find it a very persuasive argument that we perhaps didn't come up with the perfect solution in Dodd-Frank. I refuse to let the perfect be the enemy of the good, and when I do, I should simply resign or leave this institution immediately. Second, small and community banks got a lot more than they gave in the Dodd-Frank bill. The major source of competition between small and community banks were facing before the passage of Dodd-Frank was competition from unregulated check cashers, payday lenders, and other unregulated entities that operated by no rules, while small community banks had to abide by regulations. Dodd-Frank brought all these unregulated entities under regulation and in the process made them operate by the same rules that apply to community banks. Most of my community banks praise that aspect of Dodd-Frank as fostering, not undercutting competition and enhancing their ability to survive. So while I'm happy to hear from the witnesses on this panel on their various theories on how things may pan out with, quote, too big to fail, the fact is that I think a more appropriate title for this hearing would be, quote, too early to tell. I yield back, Mr. Chairman.
I thank the gentleman for his comments and turn now to the ranking member of the full committee, the gentleman from Michigan, Mr. Conyers.
Thank you, Chairman Goodlatte. I want to associate myself with the remarks of the ranking member of this committee, the parts that I understood, because this is a very complex subject. I probably won't take the full 5 minutes, but I did want to put in a mild reservation about why we are holding this hearing in the first place. I mean, it seems a little bit uncharacteristic that a bill that was passed a couple years ago is now being examined as if it is in full force. I don't think it is yet, but the needed Wall Street Reform Act, because too big to fail policies foreclose competition. And I'm hoping that we'll get an examination of how we got into this too big to fail and where it's going to lead and what it's cost us so far since the 2008 debacle. Here, members of the committee, we have 5,400 banking mergers between the last 15 years, and 74 of them were defined as mega mergers. That means that the buyer and the seller each had more than $10 billion worth of assets. Now, we need to do more to protect consumers and competition. And as a friend of the gentleman from Massachusetts, Mr. Frank, who was once a member of this Committee on Judiciary, I commend and support the Dodd-Frank bill, law now. But I don't think I'm the only person on this subcommittee that feels that it should have gone and should have gone further, and that we have a responsibility when we analyze this to determine how that can be responsibly done. Why? Because we need to do more to protect consumers and competitions in this Wall Street business that goes on. And so while the implementation process still goes on around Dodd-Frank, it's clear that the legislation is not enough to protect consumers, and that the global market still remains basically predatory, and anti-competitive practices rule in the financial industry world. J.P. Morgan Chase lost $2 billion with acknowledged irresponsible bets on the derivatives market. The British investigation into Barclays' deliberate inflation of key banking interest rates, like the LIBOR, have triggered revelations that Chase, Citigroup, other American firms may have undertaken similar actions. And so what I am hoping will happen is that we will now sleep more comfortably in our beds at night now that Title 10 of Dodd-Frank's has not developed the horrible results that had been predicted. I'll put my statement in the record, Mr. Chairman, and await and welcome and await the testimony of our distinguished witnesses. Thank you.
I thank the gentleman. Without objection, all other opening statements will be made a part of the record, and we're now pleased to turn to our witnesses. We have a very distinguished panel of witnesses today, and each of the witnesses' written statements will be entered into the record in its entirety. I ask each witness to summarize his testimony in 5 minutes or less. To help you stay within that time, there is a timing light on your table. When the light switches from green to yellow, You'll have 1 minute to conclude your testimony. When the light turns red, it signals that the witness's 5 minutes have expired. Before I introduce our witnesses, as is the custom of this committee, I'd like to ask them to stand and be sworn. Do you and each of you swear that the testimony you're about to give is the truth, the whole truth, and nothing but the truth, so help you God? Thank you very much. Please be seated. Our first witness today is Mr. Ellis Gutshall, President and CEO of Valley Financial Corporation and Valley Bank. Valley Bank was founded in 1995 in my hometown of Roanoke, Virginia, where Mr. Gutshall has worked as a banker since 1976. Mr. Gutshall is the current chairman of the Virginia Association of Community Banks. He's a graduate of Washington and Lee University and of the ABA Stonier Graduate School of Banking. I am proud to call him my constituent and friend. Our second witness is Professor Adam Levitin, a visiting professor at Harvard Law School and a professor at Georgetown University Law Center, where he teaches courses in financial regulation. Professor Levitin served as special counsel to the Congressional Oversight Panel supervising the Troubled Asset Relief Program. Professor Levitin holds a JD from Harvard Law School and 2 master's degrees from Columbia University and a bachelor's degree from Harvard College. Our third and final witness is Mr. Alex Pollock, resident fellow at the American Enterprise Institute. After 35 years in banking, Mr. Pollock joined AEI, where he focuses on financial policy issues. Prior to joining AEI, he served as president and CEO of Federal Home Loan Bank of Chicago from 1991 to 2004. Mr. Pollock holds master's degrees from Princeton University and the University of Chicago and a BA from Williams College. I welcome all the witnesses, and we'll begin with you, Mr. Gutshall. Welcome.
Chairman Goodlatte, Vice Chairman Quayle, Ranking Member Watt, and members of the subcommittee. My name is Ellis Gutshall, President and CEO of Valley Financial Corporation and its wholly owned subsidiary, Valley Bank. My bank is a 17-year-old community bank headquartered in Roanoke, Virginia, and we have invested over $1 billion in our community in the form of loans during this 17-year period. Our company has assets of approximately $800 million and 8 offices serving the greater Roanoke MSA. Well, thank you for inviting me to testify on the effects of Dodd-Frank on financial services competition. We all appreciate the importance of regulation that protects the safety and soundness of our institutions and protects the interests of our customers. We know that there will always be regulations that control our business, but the reaction to the financial crisis has layered on regulation after regulation that does nothing to improve safety or soundness and only raises the cost of providing banking services, both credit and depository related. While community banks pride themselves on being quick to adapt to changing environments and determined to meet any challenge head on, there is a tipping point beyond which community banks will find it impossible to compete. During the last decade, the regulatory burden for community banks has multiplied tenfold, with more than 50 new rules in the 2 years before Dodd-Frank. Over the last decade, 1,500 community banks have disappeared from our communities. Without quick and bold action to relieve regulatory burdens, we will witness an appalling contraction of the banking industry at a pace much faster than we've witnessed over the last decade. Holding oversight hearings like this one is critical to ensure that banks are allowed to do what they do best, and namely, that is to meet the financial needs of our communities. There are 3 key points I would like to make today. First, the costs to implement new regulations are substantial and weigh most heavily on community banks. Make no mistake about it, that burden is keenly felt by all banks. However, many small banks do not have the resources to manage all the new regulations and the changes in existing ones. Besides the real hard dollar costs, there are important opportunity costs related to products and services that either cannot be offered or will be offered only at higher costs to our customers. For our bank in 2011, we estimate that we spent over $500,000 in hard dollar compliance costs. That translates to roughly 7 cents per common share to our shareholders. Historically, the cost of regulatory compliance as a share of operating expenses is 2.5 times greater for small banks than for large banks. And I fear that gap may widen even more once Dodd-Frank is fully implemented. For the industry as a whole, a very conservative estimate of all the hard dollar compliance costs would be around $50 billion annually, and that's about 12% of total operating expenses. Secondly, the lost opportunity costs are significant for community banks, their communities, and their customers. Excessive regulation saps staff and resources that should have gone to meeting the needs of our customers. Even a small reduction in the cost of compliance would free up millions of dollars that could facilitate lending activity and other banking services. If we are forced to become more internally focused in an attempt to deal with the avalanche of regulations, we will lose the competitive advantage that we have created and that has been so well received by our customers. Customer service levels will decline, and it is the customer who will be disadvantaged by all of these actions. Thirdly, unintended consequences of Dodd-Frank have far-reaching effects on the very ones the legislation was designed to help and protect. Congress must be vigilant in its oversight of the efforts to implement Dodd-Frank and to ensure that rules are adopted only if they result in a benefit that clearly outweighs the burden. One unintended consequence occurring right now in our industry is the effort to find new and additional revenues to offset the rising costs of new regulations. Banks are increasing service-related fees in an attempt to generate the needed revenues to offset these rising costs. Free checking and no minimum balance products are disappearing from the marketplace, and it is happening at the mega banks and community banks as well. There are many other unintended consequences of Dodd-Frank, such as a host of mortgage lending rules, a burdensome municipal advisor rule, swaps provisions that will hurt my commercial customers, and the largely unknown direction of the Consumer Financial Protection Bureau, what direction that will take. In conclusion, the consequences of excessive regulation are real. Costs are rising and will continue to rise. With the regulatory overreaction, piles of new laws, and uncertainty about government's role in the day-to-day business of banking, meeting local community needs is proving difficult at best. This scenario leads us to a banking industry with far fewer competitors than we have today, which may be the largest unintended consequence of all from Dodd-Frank. Well, thank you again for allowing me to appear before you today.
Thank you, Mr. Gutschall. Professor Levitin, welcome.
Thank you. Good afternoon, Mr. Chairman Goodlatte, Ranking Member Watt, members of the subcommittee. Thank you for inviting me to testify at this hearing. My name is Adam Levitin. I'm a professor of law at Georgetown University and a visiting professor at Harvard Law School. Financial regulation is a major focus of my teaching and scholarship. I wish to make 2 points about the effect of the Dodd-Frank Act on competition in the financial services industry. The first point is on too big to fail, and the second point is on regulatory compliance costs. The too big to fail problem long predates the Dodd-Frank Act. The Dodd-Frank Act is the first step in addressing the too big to fail problem. The Dodd-Frank Act's approach to too big to fail is to identify systemically important financial institutions, or SIFIs, and then subject them to increased regulatory scrutiny and requirements. Critically, and I want to emphasize this point, the identification of financial institutions as SIFIs does not make the institution systemically important. It merely recognizes a pre-existing reality. There are 2 types of financial institutions that are designated as systemically important by the Dodd-Frank Act. First are all bank holding companies with over $50 billion in consolidated net assets. Second are non-bank financial holding companies designated as systemically important by a 2/3 majority vote of the newly created Financial Stability Oversight Council, and that vote has to also include the affirmative vote of the Treasury Secretary. To date, the Financial Stability Oversight Council has not designated any firms as systemically important. It has only published a final rule detailing how it will make such a determination. The Dodd-Frank Act subjects the systemically designated firms, non-banks and large bank holding companies, to heightened regulatory requirements. These include risk-based capital requirements, leverage limits, liquidity requirements, overall risk management requirements, the development of risk resolution plans known as living wills, credit exposure report requirements, and concentration limits. All of this will have the effect of increasing regulatory costs on too big to fail firms. We don't know how much it's going to increase the costs, but the Federal Reserve Board has recently proposed a set of standards that include 100 to 350 basis point capital surcharge on these large institutions. The goal of the increased regulation of systemically important financial institutions is twofold. First, it aims to ensure that there is better upfront prudential regulation of the financial institutions that pose the most risk. And second, increased regulation of these systemically important institutions may ultimately discourage financial institutions from becoming too big to fail by counterbalancing the funding benefits of being too big to fail with increased regulatory costs. If implemented correctly, the Dodd-Frank Act will make it unprofitable to be too big to fail, and investors will demand that too big to fail firms break themselves up. This is a conceptually sound approach that should have the collateral effect of leveling the competitive playing field between too big to fail firms and smaller financial institutions. Regarding regulatory costs, there is no doubt that that regulatory burdens for all banks, large and small, have increased in recent years with provisions like the Safe Mortgage Licensing Act that predate Dodd-Frank. What's important to emphasize, though, is that the Dodd-Frank Act itself imposes very few regulatory burdens specifically on community banks. While the Dodd-Frank Act has become the flagship of financial regulatory reform, most of its provisions have little or no bearing on small banks. 13 of the Act's 16 titles are unlikely to affect most small financial institutions. Of the few provisions that do affect small banks, many have yet to go into effect, so they cannot be blamed for small banks' travails. For example, Title 10 of the Dodd-Frank Act created the Consumer Financial Protection Bureau. Virtually all of the CFPB's rulemakings in progress could have been undertaken before Dodd-Frank by federal bank regulators. The rulemakings are under pre-existing powers. Yet had that occurred, it would have been without the CFPB's required small business impact review under the Small Business Regulatory Enforcement Fairness Act, or SBREFA, and without the cost-benefit analysis required by the CFPB for rulemaking. All in all, then, Dodd-Frank is actually creating more protections for small financial institutions rather than creating problems for them. The Dodd-Frank Act, in sum, is likely to help level the playing field between large and small financial institutions by imposing regulatory costs on too big to fail firms that will help offset their funding advantage from their implicit government guarantee. The creation of the CFPB will level the playing field between banks and non-banks, and it will give small financial institutions a voice in the regulatory process through SBREFA. To be sure, there are general regulatory costs imposed by Dodd-Frank that are likely to be harder for small financial institutions to absorb. But overall, it would seem that the Dodd-Frank Act helps level the competitive playing field between large and small financial institutions. Thank you.
Thank you, Professor Levitin. Mr. Pollack, we're pleased to have your testimony as well.
Thank you, Mr. Chairman, Ranking Member Watt, Chairman Conyers, members of the subcommittee. I believe all major expansions of financial regulation have effects on competition, even though they're principally addressed to controlling risk, and in fact, they're often more successful at changing competition than they are at controlling risk. For example, after the financial crises of the 1980s, there were three major acts of Congress expanding regulation. It was predicted at the time that this would ensure we would never again have a financial crisis, a poor prediction, needless to say. But arguably among their effects was the dominance of Fannie Mae and Freddie Mac in the market for mortgages. It's my view that similarly the Dodd-Frank Act will not prevent another crisis, although of course proof awaits the unknowable future. However, it is certain and is universally agreed that Dodd-Frank has and will continue to expand the regulatory burden on financial businesses, including community banks. The disagreement is about whether this expanded burden is worth it. My view is that it's not worth it, and among its effects will be competitive disadvantages for smaller banks. As the chairman said, if complex, expensive regulatory requirements are placed on all competitors, the burden will be disproportionately heavier for small competitors, and large firms will be relatively advantaged. Consider in this context the total staff of a median-sized bank which is 37 employees. Further, it's not unreasonable to think that Dodd-Frank's effects will impede the ability of small banks to raise capital, as has been suggested by the Conference of State Bank Examiners. Professor Amar Bedi has proposed that we reinstate, quote, old-fashioned banking where bankers know their borrowers and have case-by-case local knowledge. I bet that's a proposition we'd all agree to. But contrast this to top-down regulatory formulas in mortgage lending as a key example, which reduce community banks' natural local advantages. Regulation itself is one of the most important pro-cyclical factors in credit markets, especially in the down cycle, when regulators reacting to past mistakes clamp down forcefully. This contracts credit further than the crisis already has, as we have once again experienced. Community banks can be very successful managers of residential mortgage credit to their own customers in their own towns. A healthy, competitive residential mortgage sector, in my opinion, should feature mortgage credit risk widely dispersed among knowledgeable local lenders who also have the ability to share credits among themselves. But what did the American GSE-centric mortgage system create instead? As we all know, a duopoly system of Fannie and Freddie with mortgage risk concentrated on the banks of the Potomac. Thus, one of the most important competitive effects of Dodd-Frank is its well-known failure to address the duopoly system of Fannie and Freddie in any way. In the meantime, all actors in the residential mortgage market await and debate the QRM, or Qualified Residential Mortgage Rules. These rules will determine when mortgage competitors are required to retain credit risk in mortgages which are securitized. This is the skin in the game idea. Now, I think having mortgage lenders retain credit risk in the loans they make is an excellent idea, as long as the risk retention is a voluntary market transaction. The Dodd-Frank idea, by contrast, is not a voluntary market arrangement, but a mandatory and formulaic requirement. As has been said by many others, a notable provision of Dodd-Frank is the designation of systemically important financial institutions, or SIFIs. As has also been said, SIFIs will be subject to special regulatory requirements and oversight, a burden. But on the other hand, with regulators having devoted so much special effort to making them safe, the failure of a SIFI would be the obvious failure of the regulators themselves. The logical conclusion for a potential creditor, large depositor, or counterparty of any kind is to draw the conclusion that they will be safer with a SIFI, all political protestations to the contrary notwithstanding. Remember how various government officials tried to claim that Fannie and Freddie were not guaranteed by the government. But buyers of GSE debt and MBS did not believe such claims, and they were right. So what's the difference between a SIFI and a GSE? In my opinion, not much. Effectively, creating more GSEs will tend to make the financial markets more consolidated and concentrated. I want to just mention rating agencies, if I may, Mr. Chairman, because they're in Dodd-Frank. We are addressing a competitive issue, namely a government-sponsored duopoly, as there was in the credit ratings business. My written testimony recommends a simple amendment to Dodd-Frank regarding the credit rating agency provisions, which would create a pro-competitive approach. In conclusion, it's my belief that all proposed financial regulations should specifically take account of their effects on competition, just as this hearing is considering. And thank you for the opportunity to share these views.
Thank you, Mr. Pollack. And we'll now turn to questions from members of the committee, and I'll start with a question for you, Mr. Cutshall. Does Valley Bank compete in Roanoke with branches of large banks covered by Titles 1 and 2 of the Dodd-Frank Act?
Yes, we do.
And to the extent that these too-big-to-fail institutions receive a funding advantage, how does that affect your ability to compete to offer loans in Roanoke?
Well, it does make it difficult. The larger banks do have a better access to funding, not only from depositors, but from other sources. So their cost of funds are less than ours. in most cases as much as 50 basis points today, which is a huge hurdle to get over. We do compete. We compete on price, but we compete on service primarily, and we get most of our customers because they want to deal with somebody like our bank, somebody who understands their business and willing to spend time with them. So we cannot compete. I don't think we'll ever be able to compete with the Wells Fargos and BB&Ts of the world on pricing and cost, but we have to do it on service, and that's the way we do it. We've taken market share from everybody in the Roanoke MSA. That's why we've grown to $800 million, and I think we're a shining example of what a community bank can do.
When a small bank is forced to spend a dollar on complying with regulations, is that a dollar the bank is unable to use to finance small businesses that could create jobs?
No, we see a dollar of compliance cost or any other expense as a dollar against the profit. Profits that flow to the bottom line, we can use those, leverage them up tenfold. Every dollar of capital should produce somewhere around $10 worth of loans and investments. So it's a 10 to 1 ratio.
And a higher percentage of your bottom line is going to pay for regulations that diminish that bottom line than a larger institution competing with you. Is that generally true?
Well, I think just from an economy of scale concept, for us to comply with roughly the same regulations, maybe not to the same degree, but we have to do that as well and leverage that over $800 million in assets. A BB&T's got $155 billion in assets to do the same thing. We can't afford in-house counsel or accountants on staff to help us with this. We have to go outside. We have to pay their fees to advise us in compliance issues. So a lot of that, what we have to do, we have to go outside to get, and it's more expensive.
Now, Professor Levitin says that a lot of these Dodd-Frank regulations don't apply to small banks like yours, and that a lot of them haven't taken effect yet. But what impact is the concept of best management practices having in terms of bank regulators taking the regulations that they're required by Dodd-Frank to impose on larger banks, in which they may not have to impose on a smaller bank, but do they anyway?
Well, we realize we're exempt from quite a bit of Dodd-Frank, and we certainly appreciate that. But a lot of these things that flow through to the Federal Reserve, to other regulatory agencies, they find their way down to us as well. I mean, it's a best practices concept, and if it's deemed best practice, then we will see it, I think, without a doubt.
Mr. Pollack, what are the risks of creating disparities in the cost of doing business particularly acute in the banking industry, in which large and community banks have to compete not only for customers but also for investor dollars?
Mr. Chairman, I think it's investor dollars, but in particular it's money market funding dollars, large deposits which are not guaranteed by the government in particular, and also all businesses in which you're a counterparty in various kinds of transactions, be they securities or derivatives transactions. And in all those, as I said in my testimony, I think the large banks have an advantage which will be increased, in my judgment, by the SIFI role that has been defined by the Act.
If the banking industry became more concentrated and oligopolistic, would that harm the typical American consumer? And if so, how?
If you look around the world, Mr. Chairman, we have an unusual banking system because it still has 7,000 banks in it. Most countries have very concentrated, more oligopolistic systems. I hope we don't move in that way. Big banks have an obvious competitive role to play, but I do think there is a special advantage in this country from keeping a vibrant, robust community bank sector.
What if we fail to do that? What's the impact on consumers going to be?
I think it takes away a major consumer and business alternative, which is dealing in a local way based on the banker who really knows his customers and knows the local conditions. That's very important in maintaining a well-functioning and growing entrepreneurial economy.
Thank you. The gentleman from North Carolina, Mr. Watts, recognized.
Mr. Chairman, I think I'll defer to the other committee members since they may have some place to go. I got to stay, so Mr.
I'll
Conyers.
yield next to the gentleman from Michigan, Mr. Conyers, for 5 minutes.
Thank you, Chairman Goodlatte, and thank you, Ranking Member Watt. Gentlemen, this is a very academic discussion of a problem that is has some other dimensions. For example, can any of you explain to us about the amount of loss in the 2008 financial crisis in general?
I'll take a try at that, Mr. Chairman.
Thanks.
If I'd be
Thanks,
permitted to.
Professor Pollack.
Chairman Conyers, I've thought a lot about that. I've written a book on financial cycles called Boom and Bust, which has the advantage of being short, if you ever want to look at it.
I'm more interested than ever.
Financial cycles are apparent in all of financial history. They repeat. They always have multiple occasions. They always arise out of an over-optimistic group think, you might say. In our case, we have the interaction, as is often in a bubble, between asset prices in houses.
Yeah. How much was lost?
And the total loss. Oh, you want a dollar number?
Just
it's
roughly.
many hundreds of billions of dollars.
It didn't reach the trillions.
And the losses of Fannie and Freddie alone were $250 billion.
Right.
So it's bigger than that.
Mm-hmm. And do any of you have something that you can tell us about the fact that in many countries around the planet, there is action being considered against the biggest banks, including UBS, JP Morgan, Citigroup? I mean, this was a worldwide collapse of our financial system, Professor Levitin, that seemed to have taken economists by surprise. But now that we look back on it, there's less justification for the surprise. Is that a fair statement?
Well, not being an economist, I can't speak for them, but I think if you look back at and place the Dodd-Frank Act into context, we saw a financial crisis, the likes of which certainly have not been seen in my lifetime, and you have to go back to the Great Depression to find anything like it. And if anything, I think that what the Dodd-Frank Act does on too big to fail is too modest. That I think the approach is sound conceptually, but it leaves a lot to the regulatory implementation. And when you asked about the costs of the crisis, I think it's very important that we be cognizant of the need that we compare the costs imposed by financial crises with the costs that may be imposed by regulation. And if you're at all risk averse, I think that, this is not even a close one. That the regulatory costs here are a small insurance premium for making sure that we don't have an economic collapse.
Now, J.P. Morgan chased $2 billion loss irresponsible bets in the derivatives market. You say it was $9 billion. My colleague says it was not $2 billion, it was $9 billion. Barclays, deliberate inflation of key banking interest rates, and like LIBOR have triggered revelations that Chase, Citigroup, and others may have undertaken similar actions. Is that too drastic a accusation to be made publicly?
I don't think so. I think it's been all over the newspapers that, and I'd say with that $9 billion, I think it's $9 billion and counting, that we haven't seen the end of it, unfortunately. I think that we're just starting to learn the extent of financial institution malfeasance before and after the financial crisis.
Could I get 15 seconds, Mr. Chairman, to ask
Without objection, the gentleman is recognized for an additional minute.
Mr. Pollack his impressions of this line of discussion?
Adam and I were discussing before the hearing, Mr. Chairman, the very interesting situation. One of the most interesting aspects of it is the potential involvement of the regulators and the central banks themselves. There are allegations that the Bank of England or the government were possibly encouraging or even directing the banks to do this. It was said today that the Federal Reserve Bank of New York was aware of this several years ago. And when we discuss any financial crises, what we find is that it isn't true that regulation protects us. Adam, you and I may disagree on this. The regulators and the central banks are part and parcel of the problems. Everybody's all mixed together. That's what makes them so hard to anticipate and to manage. And that's true in this LIBOR case as well, apparently.
Thank you, Chairman Goodlatte.
I thank the gentleman. The gentleman from Ohio, Mr. Shabbat's recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Gutschall, if I could ask you a question. I agree with you that our community-based financial service providers, both community banks like yours and credit unions for that matter, are absolutely essential pillars in the American banking system. It's clear that community banks and credit unions are facing an increasing amount of regulatory burden in terms of the breadth and pace of rulemaking from the CFPB and other regulators. Regulators, including all of those that sit on the Financial Stability Oversight Council, have a responsibility to information share and coordinate with each other in an effort to make the post-Dodd-Frank environment as manageable as possible for those institutions serving Main Street. You mentioned in your testimony that Valley Bank has invested over $1 billion of investment loans during your 17-year history. You also mentioned the significant opportunity costs that come from Dodd-Frank compliance. My question is, if you had to comply with Dodd-Frank over your entire 17-year history, approximately how much do you think that Dodd-Frank compliance would have cost you out of that $1 billion?
Well, that's a very good question, and a very tough one to answer as well. Typically, if we are allocating somewhere close to 8 to 10% of our earning assets to compliance issues, that would have taken 10 cents off of every dollar. So that $1 billion we could have shrank to say 6 or 7 billion. I mean 600,000 or 700,000. So it could have cut our lending by 30 or 40%.
Okay. And Mr. Pollack, let me ask you, the name of your book again was Boom and Bust, or
Boom and Bust.
Boom and Bust. Okay. You get it on Amazon, or where is it available?
If I'm allowed to say this, you can buy it on Amazon for $9.95.
I think you're allowed to say that. But and like Mr. Conyers, the fact that it was short kind of appealed to me as well. But that's one I'd like to read. And with your knowledge about the financial cycles that we've seen over the years, repeated, again and again, and most of that time was obviously not during Dodd-Frank's existence. We now have it. What are there things that could have been done that would have made sense that could have dealt with the financial meltdown and other things, short of Dodd-Frank or different from Dodd-Frank, or what do you have an opinion on that?
Yes, Congressman, I do. And with regard to the mortgages in particular, I actually published a list of 10 things that one could have done or should have done. Of course, notable among them is dealing with Fannie Mae and Freddie Mac. Fannie and Freddie, I think, played a role which is often not understood, which was the allowing large amounts of foreign money to drive up the prices in American real estate without taking any risk. I think a general principle is if you want to invest your money and take the risk, that's fine, but by the government guarantees, as I said, denied but nonetheless real, they allowed large amounts of money to come in, drive up real estate prices, drive up risk, but not take any risk themselves, have their risk now being paid for by ordinary taxpayers as they provide the money to pay off Fannie's and Freddie's obligations. So the biggest thing would have been to deal with them in restructuring the mortgage finance market, which was the center of the problem, and what becomes in a bubble the insidious interplay of rising asset prices and ever-expanding credit, and they were major in that credit expansion.
Thank you. My time's rapidly expiring. Just let me ask you one more question, if I could, Mr. Pollack. The Community Reinvestment Act, do you have an opinion as to the relationship between that and the ultimate financial crisis that we found ourselves in this country?
Any time one is directed to make loans that look riskier to you in order to fulfill a regulation, I believe that's a mistake, that loans ought to be made as objectively as possible to good credits in order to create good credit. And the more we have a system like that, the better we will be.
Thank you.
I thank the gentleman. The gentlewoman from California, Ms. Waters, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Let me just start off by saying that I agree with Mr. Watt that this hearing is quite unnecessary, but we know what's going on. As we approach the 2-year anniversary of the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act, some of my colleagues on the other side of the aisle want to mark this occasion by trying to make the case for repeal of the act or otherwise try to undermine the regulation of an industry that nearly brought our economy to its knees in 2008. And I don't think we need to, go into what happened during the crisis and what caused the crisis. We all know what the subprime meltdown was all about. But we put a lot of time and effort into Dodd-Frank, and we listened to everybody that had something to say about it. And we have a bill that really does attempt to reform the industry. But since Dodd-Frank passed, the Republican efforts to undermine Dodd-Frank have been extraordinary. They have passed legislation to try and defund regulators, repeal the orderly liquidation of authority, repeal risk retention, delay derivatives regulations for 2 years, repeal liability for credit rating agencies, prohibit CFTC, SEC regulation of international swaps. All of this while we're witnessing some other kinds of actions that are taking place that should cause us all concern. We should be concerned about MF Global. We should be concerned about the big well in London and the proprietary trading that we attempt to try and deal with Volcker Rule. We should be concerned about the LIBOR manipulations, et cetera. So here's what I'd like to say to the community banks. You have a lot of friends in Congress. And we know that Dodd-Frank really doesn't have a lot to do with the fact that you're at some disadvantage with the big banks. We understand that. And a lot of people, even in Dodd-Frank, as we were going through the conference committee, took actions to try and relate to some of the problems of the community banks. I just feel really strange about community banks being roped into these antics of my friends on the opposite side of the aisle as they attempt to dismantle Dodd-Frank piece by piece. And I would suggest to you that if you have not seen the FDIC white paper entitled Impact of Dodd-Frank Act on Community Banks, that you ought to read it. You ought to read it, because if you read this paper, and if you're not familiar with a lot of what was done with Dodd-Frank that's to your advantage, I think that you may change your mind about joining with people who have other agendas that may not be in the best interest of community banks. Let me just ask quickly about some of the white paper that describes the impact of Dodd-Frank on community banks. Assessment base. As a result of Dodd-Frank, FDIC assessments will now be based on average consolidated assets, less average tangible equity, rather than total domestic deposits. Is this helpful to community banks?
Absolutely.
That is. Secondly, the offset of effect of increased reserve ratio. In addition, Dodd-Frank increased the minimum reserve ratio for the Deposit Insurance Fund from 1.15% of estimated insured deposits to 1.35%. Is that helpful to community banks? Mr. Pollack, you know everything. What do you have to say?
I try to pretend like I know everything.
I know.
No, I don't think that is. That suggests a higher deposit insurance premium for community banks, in fact, which is an expense.
Okay, let's go to increased deposit insurance coverage. Dodd-Frank permanently increased the FDIC's basic insurance coverage limits to $250,000. This higher coverage level should help community banks attract and retain core deposits. Is that helpful to you, Mr. Gutschall?
That is helpful, yes.
All right. In ending too big to fail, as with the increased deposit insurance coverage, the end of too big to fail will make it easier for smaller institutions to compete with larger institutions. A level playing field will help to eliminate the subsidy that too big to fail banks have enjoyed and encourage market discipline. Do you think that's true? Is that a statement that you could agree with, Mr. Gutschall?
Well, I believe that the too big to fail has obviously benefited the larger banks. I mean, a lot of customers feel more comfortable with their money in those banks, and I think the TAG program that we all participate in, which we hope will be extended, is a huge issue for community banks.
Well, let me just...
The time of the gentlewoman has expired.
Unanimous consent for at least 30 more seconds.
Now, without objection, the gentleman is recognized for an additional minute.
Mr. Pollock, exemption from Section 404 of Sarbanes-Oxley. For many years, community banks expressed concerns about the auditor attestation requirements in Section 404 of Sarbanes-Oxley for publicly traded companies. Dodd-Frank effectively exempts public companies with less than $75 million in capitalization from these requirements, which cover many publicly traded community banks. Is that helpful, Mr. Pollock?
Congresswoman, the exemption from the onerous bureaucracy of Section 404 for small companies was a pro-competitive plank in Dodd-Frank, which I applaud.
Which you applaud. Say it loudly so everybody can hear you, Mr. Pollock. I have a whole list of things here that is identified in this white paper that's helpful. Let me just say this as I wrap up, that again, you have a lot of friends on both sides of the aisle who want to be helpful to community banks. I don't want you to get caught up in something else that's going on here, which is not helpful to community banks. I believe that in addition to what we have done in Dodd-Frank, we will continue to work with community banks because we think you have real value in the community. We think people prefer to deal with you. We think it is customer friendly and all of those things. So let's be careful about being, brought up here to deal with these issues in the way that you're dealing with them, because I don't think it helps your cause. It hurts rather than helps. I'll yield back the balance of my time if I have any left.
Yeah, the gentleman is well aware that she does not, and the gentleman from Georgia is recognized for 5 minutes.
Thank you, Mr. Chairman. Yeah, I myself am also rather disturbed that you, Mr. Gutschall, would be here to testify on this issue, Dodd-Frank. You are not a bank that is too large to fail, but you are a community bank, and a darn good one, I would say, one that 17, it's a 17-year-old community bank, assets of $800 million. You're the number 4 in terms of market share with respect to deposits in the Roanoke Metropolitan Statistical Area, surpassing even Bank of America within that area. So for a 17-year-old bank to do that, I think if we have banks that are the backbones of the main streets throughout America that are as well run as yours, America would be in great shape. And so I do appreciate you, and I appreciate community banks in general. In fact, when I was a practicing lawyer, my my accounts were at a local community bank, and you know, so I'm a community bank guy, and I don't understand why the majority or the folks on the other side would bring a community banker up here to help in the effort to get rid of Dodd-Frank, which is mostly concerned with banks that are too big to fail. And I know that community banks have a lot of regulations that they have to abide by, and there are certainly more regulations that have been applied to the too big to fail entities. And I think they should be the ones up here to talk about how over-regulated they are in the face of $9 billion losses, like J.P. Morgan has admitted to finally. I think they're the ones who should be here sitting in your chair. We should be talking about community banks specifically, how we can help them become more competitive with these too big to fail entities, which it seems like, you know, that's basically who my colleagues on the other side of the aisle are concerned about. So why bring you up here as a sheep in wolf's clothing, kind of? That's just not, we don't buy that. We really don't buy that. But look, what impact did the repeal of Glass-Steagall have on this too big to fail problem that it seems like it's getting even larger with a $9 billion loss? It was $2 billion just a few weeks ago when it was announced, and then it was announced, I think, on Friday, and then on Monday it was a $3 billion loss, and now several weeks later it's a $9 billion loss, and no end in sight is what I'm hearing. What impact did the Glass-Steagall repeal have on Wall Street and the too big to fail phenomena, Mr. Polak?
Congressman, with specific reference to the J.P. Morgan trading embarrassment, I think the answer is none as far as the change of Glass-Steagall, because that trading activity could be done in a commercial.
I'm talking about on Wall Street in general, and the Wall Street meltdown back in.
I understand.
Yeah.
And with respect
which you attribute to Freddie Mae and Fannie Mac.
Had nothing to do. Glass-Steagall had little or nothing that I can think of to do with Fannie Mae and Freddie Mac.
Did Fannie Mae and Freddie Mac trade in derivatives, by the way?
Yes, they were major users of derivatives, and as you know, had a large accounting scandal about derivatives that cost the management their job.
And we need to regulate. We need to regulate that kind of trading.
Yes, well, interestingly, I mentioned...
especially when it's for the account of the entity itself. Isn't that correct?
Well, all of these things are happening inside regulated entities, Congressman. I think overall...
But not in the community banking sector, though, is it?
It certainly isn't. They have their own and different...
They do it the old-fashioned way.
Well, if they do it right, it's old-fashioned, and it's another thing I applaud. And if I could just say so, also, Congresswoman, in the couple thousand pages of Dodd-Frank, there are actually 2 provisions which I fully support.
Well, now, you already had your 10 minutes, Congresswoman. Yeah. But anyway, Mr. Professor Leviton.
Time of the gentleman has expired. Without objection, gentleman is recognized for 1 additional minute.
Thank you, Professor.
Regarding Glass-Steagall, I think there are 2 effects that are important to note. First, the Glass-Steagall separated investment banking from commercial banking. Putting them back together exposes insured deposits, in other words, the government ultimately, to risk-taking that banks do in investment banking, and that's a problem. Secondarily, and I think...
Subject to the $250,000 per account.
Yes.
Yes.
Secondarily, and I think often overlooked on this, is a political effect from that was lost. Glass-Steagall divided the financial services industry. And if you go back 30 years or so, 40 years, you would see that the commercial banks and the investment banks and the life insurance companies didn't get along. They'd fight with each other. They'd fight with each other on legislation. They'd fight about regulations. And they would litigate. And this affected the way their lobbying worked, because they were not presenting a unified lobbying front, that if you took a position against that was adverse to the commercial banks, the investment banks would love you and vice versa. What's happened is that they've found that it's easier to unite and be united front, and what that does is it makes it much harder, I think, politically for members of Congress and for regulators to prevent deregulation. That what we've seen with the demolishment of Glass-Steagall is really a politically united financial services industry, and I think that's a huge impact that really has not been noticed.
Time of the gentleman has expired. The gentlewoman from Texas, Ms. Jackson Lee, is recognized for 5 minutes.
Thank the chairman and the ranking member for this hearing. And I would like to start out, I think as many have started out, to indicate to the panelists that I appreciate their testimony, and I appreciate Mr. Gutzall's representation of community banks. And just for the record, I want to acknowledge the vital role that community banks play and the interest and commitment that your customers, clients have. They love their banks. I love my community banks that are in my constituency and work very closely with them. And I want to see them as strong, and as I noted by one of my colleagues, your record is certainly strong in terms of assets. Many others have strong assets. And so as we are debating the health care repeal, and you would ask the comparison, I always recognize that bills passed are not in their most perfect form. And we work through the legislative initiatives to ensure that we do address concerns needing to be concerned. I certainly don't want to see a repeal of the Affordable Care Act. I want to see the bill implemented to save lives. Dodd-Frank has the same basis. One might not say saving lives, but those who have fell victim to some of the excesses of some of our huge multinational banks might think that they're in fear of their lives, that they've lost their assets. Small businesses don't have access to resources, major foreclosures, still an epidemic, if you will, in the financial structure where people's homes are still being foreclosed. So I'd rather, and if you can, not having heard your testimony, and I apologize for being delayed in another hearing, but I will be posing a question to you as to singularly some item that might be responsive to some of the concerns. As you well know, you're a bigger community bank. There are certainly a lot smaller ones that many of us work with but we do believe you are a viable tool and asset to the financial system. So I'm first going to go, however, to Dr. Levitin and tell me, as you look at the FSOC and its intent, and I just want to read its name into the record because maybe if we heard its name, Financial Stability Oversight Council, that's a good sounding purpose, at least if you take the names literally or the words literally. But it has gotten in the eye of the storm. The president had to do a response through his own presidential authority, which I support. But tell me, what good can come to Mr. Gutzall with this kind of structure, even though it seems to focus on, it seems to have a consumer protection element, of course, but what is your perspective on that?
I want to make sure that we're speaking about the same thing, the Financial Stability Oversight Council or the Consumer Financial Protection Bureau.
I want to speak about both of them, so let me start with the Consumer Protection Bureau first. Thank you.
Sure. With the Consumer Financial Protection Bureau, the first good thing that can come to community banks is that the creation of the CFPB levels the regulatory playing field between banks and non-banks. That non-banks compete in all kinds of consumer finance activities, and before the creation of the CFPB, they were very thinly regulated. Now they are subject to examinations just like community banks are, and this means that they are going to have to bear the same kind of regulatory costs as community.
Could you pause for a moment? Mr. Gutzall, does that help you?
It does. I think that's a step in the right direction, and they were the ones who should have been looked at the beginning.
And those are entities that deal in real estate matters and other things that seem or financial products, let me just say, that would overlap. Is that?
Most of the overlap, I think, where we saw problems was in the mortgage origination business. The brokerage outfits did push the banks, especially community banks, out of the mortgage business.
I see common ground. Let me move on to the Financial Stability Oversight Council, Professor. Thank you, Ms. Gutzall.
The Financial Stability Oversight Council, you can think of it as sort of a Justice League of regulators, that it's a collection of various financial regulators. And I think the real benefit for community banks from having the Financial Stability Oversight Council is that the FSOC is going to designate which institutions it believes are systemically important, and then is required to impose additional regulation on those institutions.
So let's get to the bottom line. Can we find common ground for a banking structure of the community banks juxtaposed to too big to fail as compatible with Dodd-Frank? Would you find that they can actually find common ground and find a positive response to their needs as opposed to a negative response?
I would think that there are numerous provisions in Dodd-Frank that would be good for community banks. They may not, there is some increased regulatory burdens. There's no question about that. But there's also a lot of things that help community banks by leveling the playing field between either community banks and too big to fail banks or community banks and non-banks. And I think those things are really good for the city.
Is a regulatory scheme one that can be ironed out, for lack of a better term?
I think so.
Is it something that we should be looking at their critiquing and not undermine the bill but be able to respond to it?
I think that if community banks have particular provisions in Dodd-Frank that they are concerned about, those provisions should be examined. But concerns about community banks are not an excuse for a wholesale repeal of Dodd-Frank.
I just conclude by saying, Mr. Gutzall, we look forward to working with you. You have great value. I'm glad to hear that there's some components that work for you. Can we not work with the association that represents many community banks and look at it as to how we structure some of the review, and I have no commitment that anyone want to review it, but some of the review to constructively make sure we have this structure in place but respond to your concerns?
I think we can, and I appreciate that. Most community bankers are concerned about the commoditization of banking, and a lot of the times when we win customers, it's because we're more agile. We offer more options. It's just not plain vanilla cookie cutter stuff, and it's very important that community banks be allowed to continue to do that, not only in the residential mortgage business but also in business related credit.
Discretion is important in your business. It really is. Mr. Chairman, I believe that I missed getting Mr. Pollock, but I'm sure he's absorbed the Q&A that I just engaged in, and he finds common ground to be able to support Dodd-Frank and sees its great value. So I'm sorry, Mr. Pollock, I didn't get a chance to seek any answers from you. But I've already gotten an agreement, and I'm going to yield back right now. Thank you. I yield back.
The time of the gentlewoman has expired, and the ranking member, the gentleman from North Carolina, is recognized.
Thank you, Mr. Chairman. And I thank my colleagues for being here for the hearing. I guess I better give Mr. Pollock a chance to tell us which two provisions in the Dodd-Frank bill he considers good. I'm just doing cleanup now since I deferred to all the other members to last. So go ahead and let's put that in the record here.
Thank you, Ranking Member Watt. One is, as previously discussed, the exemption from Sarbanes-Oxley, another a regulatory expansion bill for small public companies. I think that was a very good idea, and I supported that. The other is not allowing bank regulation to require the use of credit ratings by credit rating agencies, since credit rating agencies were, as I said, a government-sponsored really duopoly with Standard & Poor's and Moody's. However, that second provision actually needs a slight amendment, which I recommend in my written testimony to help.
Okay, I'll be sure to take a look at that, and I assume we'd be taking that up in financial services, not in judiciary. But I'm glad to get those 2 points into the record. I want to publicly agree with Mr. Pollock that we never thought that Dodd-Frank would prevent any future financial crises. History, based on the research we were doing and all of the studies that when we were doing Dodd-Frank indicated that every 27 years or so there's going to be a crisis because you regulate and then you deregulate, and the profit motive becomes a lot more salient than the regulatory motive, and over time you just that's what happened. What has happened throughout the history of our country. So we're figuring Dodd-Frank is good for maybe 27 years, if we're lucky. So I agree with you. The final point I want to make is also something that you said. You seem to applaud the value of know your customer in one of your comments. I just wanted to remind you that I was the chair of one of the subcommittees when we were dealing with know your customer, and it requires substantial regulations. All of the banks were complaining about the regulations that went with know your customer. So the good old days ain't as good as they seem sometimes, so I appreciate all of you being here. I didn't think much of the hearing, as I said in my opening statement, but you know, sometimes even good things come out of bad hearings. So I'll yield back, Mr. Chairman.
I thank the gentleman for his admission that good things come out of the hearings that are scheduled to this committee, and I happen to agree with that. And I'd like to thank our witnesses for their testimony today, and without objection, all members will have 5 legislative days to submit to the chair additional written questions for the witnesses, which we will forward and ask the witnesses to respond as promptly as they can so that their answers may be made a part of the record. Without objection, all members will have 5 legislative days to submit any additional materials for inclusion in the record. And with that, I again thank the witnesses.
Mr. Chairman, might I ask that we just put into the record the study that Ms. Waters was making reference to, so that
we get that preserved in the record.
Certainly, without objection, the study will be made a part of the record. And
It is entitled Impact of the Dodd-Frank Act on Community Banks.
Great. If you'll provide a copy of that to committee staff, we'll make sure it's made a part of the record. And I thank the witnesses and declare the hearing adjourned.